We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
There's a place where the gold runs deep. And when you strike big. Meet Nevada's fastest growing mineral claim holder in the heart of elephant country. Visit nevadaking.ca to follow the story.
Welcome back to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is John Case. He's a portfolio manager at CI Global Asset Management. How are you today, John?
Good, thanks. Yourself?
Great. Why don't we start by telling us a little bit about what CI Global is all about and what they manage?
Sure. So CI Global Asset Management is one of Canada's largest asset managers. We run over $200 billion in assets. Myself, I'm manager of the Sentry Precious Metals Fund and some of the other precious metals mandates, along with the Sentry Global Resource Opportunities Fund. So I'm in charge of, everything that's dug out of the ground, sort of my purview.
Excellent. Well, it's a great perspective to be able to kind of give to our audience here. So I wanted to start by maybe taking a bit more of a macro view and asking you if you think that we're experiencing somewhat of a dead cat bounce scenario here, where the currency that was created recently to create the backstop for the economy sliding back earlier this year, is that keeping optimism afloat right now?
So, when we say dead cat bounce, I think you kind of have to maybe split that up. And are we talking about for the economy or the market? Because they seem to be two different things. Judging from the way you phrase the question, I think you're probably talking more about from the economy than the market. Because, the market, a lot of people are puzzled at how, the market continues to grind higher in the face of, what is a pretty challenging economy. And I think people are coming around to the realization that the financial market's quite different from the economy. So on the economy, as you mentioned, we've got a lot of currency that has been printed, just a tremendous amount of debt that the government's had to print and monetize to backstop, as you mentioned, the COVID crisis and effectively just sending out checks to people, and the Fed's monetizing, probably over half of that debt that the US government's issuing right now. So, that has certainly put a floor in the economy, but keep in mind that a lot of those stimulus checks actually boosted up household income, right? In many cases, it didn't, or in an aggregate, I suppose, if you look at it, it didn't just replace income people had lost. We actually saw household incomes go up, right? So a huge shot in the arm, kind of counterintuitively. But I don't think people appreciate that those have rolled off. So, I think unless we get a new round of stimulus, you're going to start to see that bite on the economy. And I think ultimately, just for that very reason, I think it's a foregone conclusion. More stimulus is going to have to come just to keep the ball rolling as the economy heals. I think, the economy, I think, is probably put into the bottom, especially given what we've got on the horizon with the vaccines. But I think, the pace of recovery is going to be slower than expected. So it's the classic kind of down an elevator, up in an escalator type of phenomenon. So I don't think it's a dead cat bounce. I think we slowly grind up higher here, but I think it's going to take a ton more currency and a ton more paper to paper over this issue.
So as we talk about grinding higher, it just makes me wonder what the biggest risks are, in your opinion, of another possible crash right now. Do you see us just continuing to keep grinding higher and grind our way through this right now? Oh,
absolutely. Look, the Fed, and not just the Fed, every central bank is just printing money at an unprecedented pace. And that's going to inflate financial assets. I guess your question is, what does it do for the global economy? But, I think you've got that tailwind behind you to drag up the global economy with, effective debt monetization. So for me, the biggest risk was that a vaccine wouldn't be found, and that we'd kind of have to figure out how to manage this COVID crisis long term. And I think structurally that would have just caused a tremendous amount of pain for, worldwide, for the global economy to figure out what the global economy looked like, with having to do away with a lot of kind of face-to-face interaction. So I think, with some of the vaccine news we've had, I think that risk is fading, to be honest. So there's lots of risks out there, but that's the big one that's fading. Longer term, the debt pile that's piling up and has been piling up since the financial crisis. There's going to be a day of reckoning on that. I don't know when investors step back and say no more. The interest in digital currencies and gold, I think, certainly speaks to sort of investors preparing for that one day. But right now we have a glut of savings. There's not a whole lot of demand for those savings as form of credit demand. So governments continue to get cheap funding. And as long as that's the case, this debt pile is not going to tip over. But we just know from history, it won't always be that way.
Absolutely. So, John, I wanted to get your thoughts on why each unit of debt that is created is not having the same effect of GDP growth as it used to.
That's an excellent question, right? And I think that's the question most central bankers have been asking themselves since the financial crisis, right? We all have been, right? The Fed has been printing since 2008, right? It's been 12 years of this. There's been a massive increase in monetary base, but no inflation. Now, the game has changed a little bit in the last few months, right? We've seen M2 explode, right? With a lot of the government guarantees that they've announced post-COVID. So that is interesting, but still, I think that you have to ask yourself, what's changed in the world in the last 12 years? Why is this money printing not causing inflation and really causing GDP to accelerate the way that, when you put your pedal down on money growth, how it used to? The Feds, as you know, they're very model driven, and their models have said that inflation's coming, and that kind of caused them to raise rates and get off zero. But now, they're throwing all that backward-looking style of model-driven framework out the window, right? And that's part of what this announcement of their new FATE, their flexible average inflation targeting policy, is all about, right? Because the velocity of money has collapsed. And that's a fancy output of basically just saying, if I'm creating more money and GDP is not growing and prices aren't changing, well then, we're going to solve for the variable, which is, V, and it's the velocity of money. And it's basically meaning money's not working its way into the economy or changing hands. So this tsunami of money is not influencing prices. And it really is the kind of conundrum of financial markets for the last decade. Reserves have been created, but they're just sitting as deposits. Like the central bank just has no way to force them into the system. It can't loan. The Fed can't directly loan to consumers. And it can't force consumers to take loans. And it can't just give currency out to people, right? So, the banks are sort of that intermediary, and there's just no pull for that demand, for that cap, for those reserves. In the past, the Fed could control output by controlling credit and money through their kind of only tool being short-term rates when there was a demand for it, right? So you could throttle it back up or down depending, as long as there's a pull, you can kind of tweak the economy and credit growth. Pumping more money into the system, we now know, doesn't work if there's no demand. It can't be pushed. If there's a pull, you can throttle up and down. But if there is no pull, it can't be pushed the other way, at least not with conventional monetary policy, right? You're seeing that in Fed surveys showing declining loan demand. And it's why the Fed's been calling for fiscal stimulus. They're saying, we are pumping so much liquidity in the system, creating so much money, and we're not getting anything for it. We're not getting any GDP growth. We're not getting the inflation. So we need something to pull as well, right? So we need to find a way to directly spend that money. And when they figure it out, that's going to be the regime shift. That's going to be the game changer for inflation, right? And I think where it's headed all, and the end game is this is going to be a combination of fiscal and monetary policy levers, printing money to directly fund government investment. Government's probably going to step up its role as an employer, and you're going to start to kind of blend that, get sort of, independence between the central bank and monetary policymakers and the government. And originally, the Fed's designed to reduce inflation, not increase it. And I think that once you tear down the walls between the central bank independence and governments, which is happening all over the world, it's not just the Fed, you're not going to get that genie back in the bottle, right? Governments don't like tight policy. And why would they ever? It would never get you reelected having a tight policy, right? They want to run the economies hot. And I think the Fed, they've got a dual mandate, price stability, full employment. If you read the comments from the Fed, they're kind of throwing out the book on the price stability. Like they're more worried about employment than inflation, right? They're talking about running it hotter. That's part of what this FATE policy is going. They want to see the inflation trickle down to really low income individuals, which hasn't happened. Stopping inflation, it's leading to this divergent wealth gap that you got in the US. And the Fed feels that they're partly responsible for that. That having hotter inflation than they're used to is more likelihood of that trickling down to wage inflation, the lower tiers, right? That the people with the worst skills, the sort of last people to come into the labor market, we need them to get pricing power and wage inflation. And you really only get it if inflation is a lot higher than the two that we're getting. So old policy is gone, new policy is in. It's going to be, government and Fed are going to be more one and the same. Inflation is going to be higher than we're used to. And I think that's the regime shift that's coming up. And we're going to have the more sort of inflationary types of policies. I think you can see direct government intervention to create jobs, influence wage setting. All of these tools, I think, could be on the table. And I think all of them are gold friendly and ultimately are going to end up in a total shift higher as far as inflation expectations.
So, John, when you're saying that there's no inflation, do you just mean that there's no inflation as the government is measuring it? Or do you think that there's not really any real inflation, period?
Both. Certainly, like we know, like the inflation measures they're very difficult to calibrate, right? So, and the government has a tough time measuring like technological change, right? How do you incorporate that into measures of inflation? I mean, when we talk about inflation, we talk about consumer price inflation, right? Which is one way of measuring debasement. But there's also, financial, like asset price inflation, right? So it's not things that are consumed, but look at asset prices, right? Asset prices are going up like 20, 30%, since this all began, right? So there is a form of what I would call inflation, asset bubbles. And that's what a lot of this money printing is causing. And to be honest, it's not a direct cost to a consumer, but there's an opportunity cost to it, right? Like if you don't have money in the financial markets, like all of a sudden, everyone else is 30% better off, right? What they're doing is having inflationary results, but it's not where they want to see it, which is in consumer prices. The money ends up with people who go out and spend it. That's what they want to see, right? Because spending money ultimately lowers unemployment, more people in jobs, and that's really fulfilling their goal, right, of maximum employment. The money that they're printing, it's ending up in the financial markets, right? Asset prices, housing. So there's two different ways you could go with your question. Are CPI measures rigged? Are they properly determined? And that's a whole, rabbit hole you can go down. But I think, at the end of the day, we're not seeing much CPI because there's not a whole lot of wage inflation, because there's huge slack in labor markets. But we are seeing inflationary type things in the form of asset bubbles in financial markets. And I think as long as you continue to print money the way they're doing, that's going to continue to happen. That's why they have to figure out a way to start getting money to consumers, right? That's why they're thinking about digital currencies and giving it out directly to people, helicopter money, right? They're pushing on the government to do more fiscal because that is much more targeted towards getting CPI up, output up, and get away from sort of the financial type of asset inflation that we're seeing.
Right. So I kind of want to go back to something that we were talking about GDP and like you just said, about output. So where is the danger level of debt to GDP ratio, and what are the consequences once that level is reached?
Yeah, it's a great question, right? And like, to be honest, it's changed, right? Tom, in 2018, we were warning our clients that historically the CBO projections, the Congressional Budget Office in the US, was projecting US fiscal deficits of 5% annually for debt to GDP, right? So your debt was going to go up, 5% per year. Then that was going to kind of take debt to GDP from 100 to 125 over the next 5 to 6 years. 125 at the time, we were like, okay, that's a scary number. That's kind of where Italy got tipped over. And, here we are at 105% in kind of late 2019. And then bam, we've gone to 126% debt to GDP in 1 year. When you look at the $2 trillion deficit that we had, this year with COVID. And layer on top of that, right, you had tremendous tax cuts, right, which lower revenue for the government from Trump's, policy early in his term. So we're at 125%, about 4 or 5 years earlier than we expected. 2 years ago, when we were warning people about this in 2018, I would assume this would be the tipping point that we're at today, right? It's just phenomenal. So, we're already so far past the point of where anybody would have thought that there would be some backup in yields as far as the willingness of people to lend to a sovereign at this sort of debt to GDP level, that it's tough for me to really know what happens next. I mean, there's no real theoretical limit on debt to GDP, mm-hmm. But so to be honest, we're sort of in uncharted territory. I think there is a glut of savings globally. I suspect that that's part of the reason you got just a lot of money sloshing around looking for a home. And willing to finance sovereigns at rates that would be unheard of normally, given the levels of debt that they've incurred, right? I mean, governments, they're the guys that never really restructured after the financial crisis, right? The financial crisis, no one ever restructured debt. We just moved debt to the government. The problem just got moved from individuals and corporates to the sovereigns, right? When they basically monetized debt and did a lot of debt guarantees and just transferred and made good a lot of people's debts and transferred onto their balance sheets. So, it's piling up there. It's a problem. I suspect when it becomes a problem, it's going to happen very quickly. There's not going to be well telegraphed, and it'll probably be when some of these savings, find a home. But for now, I think we're so far past what would conventionally be a danger level. It's difficult to know.
Mm-hmm. So when you're saying that there's a global savings glut, do these people become the biggest losers when the currency is being debased at this rate?
Yeah, that's a good point. There's a great book by Reinhard and Rogoff called This Time It's Different, 900 Years of Financial Fall. And if you've never read it, it's a fantastic book on debt crisis. One of, that and Ray Dalio's recent book on debt crisis, probably the two most interesting pieces you can read on debt. And I'd say after reading historical literature on debt, you just walk away thinking, who would ever loan money to a sovereign, right? I mean, it's just the track record of them destroying their currencies as a way to delever. It's so pervasive across history, right? And politicians, ultimately they're in there for 4 years or 5 years and they move on, right? So, or 8 years, even if they get reelected in the US, but they're not in it for those 25, 50-year debt cycles. So it's somebody else's problem. So really, I think the guys that get the biggest losers when currency is being debased at this rate are lenders, right? Back in the day, when it was like the British Empire and they'd, loan a bunch of silver to Argentina, like if Argentina didn't pay back, they'd go in there with their warships, right? To get their silver back. I mean, that's how it was done back in the day. That's how countries got repaid. But now, right? I mean, military conflicts don't happen over it. It's debasement, right? You got fiat currency. You get paid back in your fiat. Just the purchasing price might be gone. It just might not buy anything anymore. So, the guys that get wiped out are the lenders, right? The guys who are lending stuck, they're long fiat. They think they're getting 3-4%. They get back their fiat, it doesn't buy anything when they get it back because the purchasing power has been debased. So much better to own gold or even equities, right? I mean, equities are repricing themselves higher and debasing currencies. And we've seen that. That's why equities are up, the way they are over the last year. So, it's like that poker proverb. If you don't know who the sucker at the table is, it's you, right? And the biggest suckers in this market are the guys making 30-year loans to governments at some ridiculously low rate. Every policymaker is laughing, right? They're pumping up every asset except for the one you own, right? You're going to end up getting that fiat back 30 years from now that's not going to buy what it used to. So sure, there's no CPI, but there's a massive opportunity cost if you're a holder of government bonds, right? And there's structural reasons why guys have to buy government bonds, like insurance companies. But man, if you're an individual, you're not an insurance company, you got a 60-40 balanced portfolio, like that's not defendable given the regime shift we're in, I don't think, right? Not in my opinion. You're picking up 1.5% when the rate should be 4%. So great, making 1.5%, and then inflation pops up, or if whenever investors step back and say, "Hey, we're not doing this anymore," loaning to governments at 1% with your long duration, your portfolio drops 16-20% on the 40% part of it. So that makes no sense to me, and I think that's why you hear a lot of people, smart people, financial press, academics, market practitioners like myself talking about like the death of the 60-40 portfolio. I think that's going to be a casualty of this zero interest rate policy.
So, John, one of my questions that I had written out for you was, what's the greatest threat to the US dollar? But it almost seems like you're saying the greatest threat to it is almost itself, because it could just be continued to be printed and debased at an alarming rate, correct?
Yeah, I mean, it's an interesting question. What's the biggest risk to the US dollar? US dollar is the world's reserve currency, right? And it's very difficult to kind of kick it off its pedestal, because you kind of come to that, okay, well, like what else could we use, right? And that's one of the reasons why why rates have been so low in the US, is because as the world's reserve currency, those glut of savings have to go somewhere and they go to the reserve currency. So you're able to borrow at unbelievably low rates. I think the biggest risk to the US dollar, it's not just the US dollar, it's every fiat currency really. It might be digital currencies. So, a way for money to be created outside of governments that can debase fiat. I mean, that might be something that becomes quite interesting down the road. You're seeing central banks that are worried about getting left behind by innovation if that happens, right? Like, for money to be created outside the halls of powers is just scary if you're a central banker, right? You only have monetary policy. You only got one tool. If you can't implement it, you lose control over everything, right? So, I think that rather than try and ban digital currencies, they sort of thought to like adopt it, digital currencies, at least look at it, right? So, just last month, the Bank of International Settlements came out with a report called Central Bank Digital Currencies, Foundations and Principles, right? So they're looking at it, right? And the Fed signed off on that. They were a co-signatory. So it's coming. I mean, what does it really mean? I mean, our cash is digital now. So like, this is kind of evolutionary to me. Like, sure, it's decentralized. There's some new speed and security features that are innovative, but like, it's not really a bridge too far, something radically different, but I think the real interesting aspect of it, because you're just going to, a central bank cryptocurrency effectively, is going to be the ability for stimulus to come directly to an investor, right? So rather than mail checks, you just credit a currency account held at a bank, right, in crypto. And all of a sudden, everyone's got, it's helicopter drop, right? So what do you do, helicopter drop? So the Feds looked at it. I know they don't want to disintermediate the banks, and you obviously don't want to challenge that reserve currency and have people have something else. The Chinese government's not a reserve currency. They're trying to get mainstream adoption. So, I was on a call with Ben Bernanke last week, and he was sort of saying that the Fed, he thinks, are sort of paying attention to what, like Facebook is doing with Libra and what the Chinese government's doing with their cryptocurrency, and letting them blaze the path because they're not mainstream currencies. The Fed doesn't feel like they need to be the front runner on this because they have that reserve currency status. But it'll be interesting to see if, one of these central bank cryptocurrencies, if they do gain steam, that could potentially, I don't want to say threaten the US dollar, but you're going down that route of giving investors other options of holding fiat that can't be controlled by government. So central banks have sort of decided to get on board rather than let this kind of leave the station without them. And I think that'll be interesting. But, that's not going to be a threat to the US dollar over short term. I don't see anything being a threat to the US dollar over kind of the shorter to medium term.
So will gold act as a hedge to this currency destruction in either an inflationary or deflationary scenario that we could experience going forward? And which scenario to you is most likely?
The neat thing about gold is you don't really have to guess.
Mm-hmm.
We've studied this. We've looked at deflationary periods and look, there's not a lot of really bad deflationary periods to study. The ones that happen are really, really bad. And policymakers have been pretty careful not to let those repeat. From a data point standpoint, we don't have a lot. But, I think from the ones we do, gold's in a deflationary environment is fantastic because, deflationary environments are cataclysmic, right? Things get bad really, really quickly. When every day that passes, you got to pay back more and more debt, right? I mean, that's effectively what deflation is. So it's insidious. We don't want it. None of us do. But from a safe haven standpoint, gold does quite well in that. I mean, sure, inflation drives up gold prices as gold reprices itself in depreciating currencies. But in deflationary times, it sort of switches to more of like a safe haven asset. And it also tends to do quite well on a price, particularly on a relative price performance basis. So I think the regime doesn't really matter. I think frankly, where gold doesn't do well is sort of like the kind of Goldilocks period that we've been in post-financial crisis, right? I think where, you got things, the economy doing well, real interest rates rising, inflation's in check, right? Like I'm ticking all those boxes. But I think that regime is over right now.
Interesting. So, John, what are some of your considerations when looking at gold equities as part of your portfolio? What are some of the risks that you would associate with owning equities versus, let's say, physical gold?
Considerations. When you look at a gold miner, you're looking at a company, right? You're looking at a company that produces gold as its revenue stream. So, that's obviously attractive, leverage to gold price. So that's, one of the key differentiators between just buying, physical metal, which really only goes up if the price goes up. A gold mining company, if it's well run, should be able to generate cash. So a yield, not just like physical's got a short-term negative yield because you got to store it. It should be able to generate a positive yield as a business that generates cash. It's got to generate cash that doesn't have to be plowed back into the business, which is a real key differentiator, right? A lot of the gold companies generate cash, but then there's no free cash. You just all reinvested back in the business to keep the things going. So it's not really a business, right? If it doesn't generate any net cash. And then, I think, one of the things that we really spend a lot of time looking at is, okay, business generates free cash flow, check. The most important thing though is, can they reinvest that cash to grow, right? So can they grow wealth, not through financial engineering and just, the value destructive M&A, but can they go and find more gold than the market's currently pricing in, through exploration? If you find those businesses, they should be able to deliver returns in a flat gold price environment. Right? Gold price doesn't have to do anything. You got a business, you're generating cash, you're finding more gold, you're generating value for shareholders. So as a group, they don't do it, right? They can't deliver on that. They haven't done so as an industry, for a long time. That is true. But the truth behind that is for much of that period that you're looking at a horrible pricing environment, right? Very difficult to run a business. with, no margin, low gold price, or what we would call maybe a high gold price, but your input costs went up just as high. So you didn't get any margin expansion and be expected to return capital to shareholders and grow, right? It's a bridge too far. They haven't been able to deliver that. But, I think the current environment we're in is different from that environment. Call it the kind of, the 2010 environment. I think we have a very, very strong metal price market right now. So very strong margins. You've seen consolidation. I think the industry is set up to do now what it hasn't been able to in the past. And then on top of that, they offer leverage to the metal. Now the leverage, it cuts two ways, obviously. So, if you want to protect your portfolio with gold, you need a lot of it, right? I mean, for it to matter. So we've had institutional clients that just aren't comfortable having like a 10 to 20% portfolio allocation to physical gold, which they kind of thought that they needed to get the benefits of its protection in down markets. So what they've elected to do is have 5 to 10% of the equities instead. Because the equities have higher leverage, it gives them the sort of same impact without the same sort of drag on their portfolio if their outlook is wrong and we're in a sort of Goldilocks environment where things get better. So, that the pros, I guess, it's the cons, you got higher volatility than physical. Sometimes stocks act like stocks, not stocks that produce gold. So there's periods when gold does just fine, but the gold stocks are falling as multiples contract and they're kind of acting more like stocks than gold stocks. So that can be, maddening for gold equity investors in those kind of periods. So those are some of the challenges, but I kind of listed some of the benefits, earlier about the potential for the business to grow in a flat price environment where physical obviously doesn't do that.
Mm-hmm. So would you favor a gold equity that pays a dividend higher than one that doesn't?
There's been a lot of, not debate, but certainly a lot of noise about return of capital in the business. And I think return of capital is a great discipline for companies to have and to think about. And I sort of applaud people like Mark Bristow at Barrick, looking at dividend policy, Endeavor Mining Company we own just announced a dividend policy. Like all these things I think are great ways to telegraph to generalist investors what I just discussed about how the sector in this pricing environment can perform fundamentally a lot better than in previous periods. At these margins, there's a viable business here. I think ultimately, though, if you're going to look to invest in the gold mining equities, you have to decide, am I looking at through the space through a value lens or a growth lens? And I think, dividends are great. And if you're a value investor, that's attractive. But I think if you look at the space and allocate capital and decide on what you're investing in through a value lens, you're going to get roasted in the mining business. It does not work for value investors. So I look for growth, not value. Value investors, sort of a value lens, you look for cheap assets, looking at things that are, cheap, at a discount to underlying NAV or underlying book. What you'll find is you'll make investments and you'll find in hindsight afterwards that your estimate of net value or book value is too high rather than the value of the company being too low. Right. So you get whipsawed that way. I mean, what I'm looking for business that can grow. So yeah, I want a business that can pay a dividend. Like that, and all that's saying is that I've got a lot of high net cash, right? So I've got a lot of cash that I don't need to plow back into the business. I could pay that out to investors in a dividend, but I'm not in it to make 2 to 3% a year. I want a business that can generate that type of free cash, 2 to 3, hopefully more like 5 to 10 is what I'm looking at. But really what you want is someone that can compound that. What I want is someone that can reinvest that in their business and double the size of it or triple the size of it, right? Like I'm looking to make 2 to 3 times my money over long term. I don't want something that's generating a 2 to 3% yield that might be trading at a 5 to 10% discount to comparable names, right? Like that's below my hurdle. I'm looking to make 2 to 3 times my money. And for that, you need that wealth creation. You need that ability to, through exploration, to really grow your business. And ideally, you want to fund it through free cash flow, not through raising equity.
Excellent. So, John, I also wanted to get your thoughts on, holding gold through ETFs that are supposedly backed by gold versus ones that are comprised of, let's say, miners like GDX or GDXJ. So tell us a little bit about if you would kind of park some of your money there as well.
Yeah, well, look, I mean, ultimately I run the Sentry Precious Metals Gold Fund. So, so I'm biased versus a physical gold ETF. There's nothing wrong with physical gold ETFs. I talked about, a little bit of the difference between, why gold versus why a gold miner and pros and cons of both. I like the attributes of a gold equity more than just holding the metal. I like the potential to make money without an exogenous factor like the metal price helping me out.
Mm-hmm. So do you spend any time thinking about silver versus gold and trying to find, let's say, a producer that's focused more on silver?
Yeah, I get asked that question a lot. Certainly there seems to be a lot of interest in silver, not just now, but just, when I speak with retail shareholders and unit holders of the Sentry Precious Metals Fund, there's certainly a lot of interest usually in silver and finding silver opportunities. I look at every mine commodity looking for opportunities. Like I mentioned earlier, I run the Sentry Resource Opportunity Funds, and we're heavily invested in new energy metals. I think the downturn in those since early 2018 has come to an end. Biden's going to be the last, guy to really push the US on a green agenda, and, Europe and China are already doing so. So that's going to stress upstream inputs on battery metals, rares, and silver potentially from its usage in solar panels. When you dig into that solar argument for silver, I don't think it's quite as much as maybe some people would lead you to believe. I think silver does have an industrial bent, right? So I think with an economic recovery in the US on top of the growth in silver and solar is well positioned. Loadings and panels, which is kind of one of the main thing people will cite as a sort of demand driver for silver, those are dropping, but that's getting offset by volumes. The net's positive, but in our numbers, it's just not as big as some people might hope it is. We're seeing kind of maybe 50 million ounces of incremental silver demand from solar over the next 3 years. In a 1.3 billion ounce market, that's kind of like 2% demand growth. So it's good, maybe not transformational, but certainly silver's got, some interesting tailwinds behind it with that sort of industrial recovery, that might, match the economic recovery globally, and the more specific kind of its penetration for electronics and solar kind of getting a tailwind from green energy. So silver's got some interesting things going for it. Finding silver equities, that's the tough part. Right. Let me know if you find a good one. They're often trading at huge premiums when you find a good one. It's a lot easier to buy silver, the metal, than it is to find a good silver company at an attractive price. There are some good silver discoveries out there. They just trade at such massive premiums to what we can find equivalently in the gold space. That we typically gravitate towards gold equities. But we do own a few silver equities, but they're in the exploration kind of phase of development. We don't own any primary silver producers.
Interesting. John, do you have any other thoughts that you'd like to share with our listeners before we wrap up here?
We can talk about what's going on this week, right? I mean, it's been a tough week for gold investors. You've seen Bitcoin flying, and I think when you look at the performance that gold's had this year, it's safe to say that there's some hot money flow, right? Whenever you have something that goes up that much, you're going to get momentum, quant buyers, hedge funds, fast money that piles on until the trade stops working, right? So, technically we've broken down here a little bit. We've broken a few of our support levels. And, here we are holding our 200 moving day average. I think we hold here. You are seeing some rotation out of golds from some of these faster money accounts into, of all things, Bitcoin and some of these crypto companies. And that's, that is hot flow, and that's just something you have to stomach that comes in and out of a small sector like gold. It can push things around. I don't see Bitcoin as a real competitor for gold. To me, it's more of a growth asset. It's not a store of value. But that fast money chasing at trades causing some pain this week. But look, we talked about the longer term things that are happening, right? I mean, inflation expectations, I think, rise. Central banks accommodate this, probably even add to their balance sheet stimulus. They are going to suppress the yields short term. They are probably going to change maturity purchases out the long end to hold down the long end. They're going to allow things to run hot. Gold's got no yield, but it's got a track record of maintaining purchasing power, right? And I think, that in a currency that can't be printed, and so I don't think there's any reason to believe that won't continue. 0%, I've said this many times, like it's not great, but when the Fed's holding things at 0 and they want inflation over 2, that pushes at least short rates, that's pushing short rates below negative 2% real, right? And at the long end on 10 years, you're only at minus 80 beeps, minus 90, but like there's a potential, I think, to push that down to -2. And I think if you can get, easily, I think retest -1, and I think you can test -2 on tips, 10-year tips. And I think if we get there, gold's back through 2000 a heartbeat, probably more like 2200-2300. But, we probably have to churn here for a little bit, until we sort of get, that kind of next leg of the regime shift that I talked about. So that, the fiscal, alongside sort of, whatever it is the Fed does next to stimulate. And that's probably all Q1 events, Q2. So we've got a bit of time here to go, but I think long, I think the thesis is still intact, and this is a short-term pullback. And I think we're right on our 200-day moving average. So for me, this is sort of a good level, right? I think everyone's been complaining, they haven't had a chance to buy. It's happened too quickly. Where's your entry point? And now things have pulled back, and people are looking at growth assets. I think this is probably your last chance to buy at these levels before we move up. So I think this is the pullback that investors shouldn't squander.
Yeah, it always reminds me of that quote that goes something like, the stock market is the only place that when things go on sale, nobody buys.
That's a good point, right? I mean, that's how bull markets work, right? Like when you look at a chart in hindsight and you see this sort of, move up and then pull back and move up. When you're living through the pullbacks, you don't have that benefit of hindsight and know that your next leg is up. Like the whole idea of pullbacks is to wash everyone out. So everyone thinks it's over. Right. And then you turn back up again and then you end up, this kind of Elliott wave pattern where your sharp moves up and then you have pullbacks and then sharp moves up. So, we're in that sort of type of wave 4 environment or wave 2 environment, if you want to call it.
Excellent. John, where can any of our listeners find more about the funds if they'd like to?
CI.com would be the best place to go, and you'd be able to find information about myself and, the mandates I run, the main one that we discussed being the Sentry Precious Metals Fund.
Perfect. All right, John, thanks very much for your time today.
Yep. Thanks for having me on.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.